Welcome to Financial Fitness Society. My name is Gertrude Bett, and I'm your legal and financial literacy coach. In today's episode, we shall be covering the ins and outs of Index Universal Life Insurance. But before we get into it, we need to talk about what's currently happening in the markets because it's affecting every single one of us. In just a matter of days, 850 billion was wiped out from the US stock market as major indices plunged. This is led by massive sell-offs in tech giants like Nvidia, Amazon, and Tesla. And it doesn't stop there. Globally, the tech sector is being shaken by what analysts are calling the SaaS-pocalypse, where 850 billion evaporated from software stocks after new AI tools disrupted investor confidence. Meanwhile, the S&P 500 just hits its lowest point of 2026, sliding 1.5% amid fears of stagflation and an escalating energy crisis. This is not normal. This is a wake-up call. And that's why you must subscribe right now and hit that subscription button and turn on notification. We are entering a financial era where traditional retirement vehicles are failing and people are losing money faster than they can save it. At the same time, there's a surge in insurance litigation, especially around Index Universal Life Insurance, because agents are over-promising, under-educating, and improperly structuring policies. People are suing because they were shown unrealistic illustrations, their policies were not max funded properly, their death benefit options were wrongly designed, their cash value underperformed, their agents chased a commission instead of designing a long-term strategy. And here is the truth. Most agents selling IULs do not understand how this product actually works. And this is why this channel exists. I'm here to teach you the real mechanics behind IUL so you can protect your family, your money, and your future. So let's break down the IUL from the inside out. By the end of this video, you will understand more than most licensed agents. Death benefit, which is the foundation of Index Universal Life Insurance, is the amount paid to your beneficiaries when you pass away. But here's the key. How you structure the death benefit determines how your cash value grows. There are two main types: the level death benefit and the increasing death benefit. When it comes to the level death benefit, this death benefit stays the same. It never changes, it never grows, it just stays the same. Then the cash value grows under it. And this allows for lower cost of insurance over time. This is also great for maximizing long-term cash accumulation. And then there's the increasing death benefit option. Among others, there's the graded death benefit option, and then there's the optimal switch death benefit option. For increasing death benefit option, payout is generally the original face amount plus the policy's cash value. For example, if you have a 500k face amount plus 200k cash value, you put them together to get the total death benefit, which is now 700,000 in this case. Here, the net amount at risk for the insurer, which is the insurance company, tends to stay more constant. So the policy carries a higher ongoing insurance charges than the comparable level death benefit design. This is often preferred in the early stages of funding, especially for younger clients, because it can allow more premiums into the policy without triggering a MEC limit, which is also known as the endowment contract, which limits and grows the total protection as cash value builds. Then we have the graded, or what is also known as the modified death benefit options, which means the full death benefit is not immediately payable for death from natural causes in the first few years of the policy. Instead, in case you die, your beneficiaries might get only premiums paid plus interest or a percentage of the face amount. For example, maybe 25 to 50% during the first 2 to 3 years waiting period. In the graded death benefit, this design is common in simplified issued policies where underwriting is higher and the insurer, which is the insurance company, is taking on higher health risk. Because the insurer's risk is higher, internal policy charges are often higher, and this drags on cash value growth. In addition, some modified designs delay or slow early cash value accumulation. So even though you have permanent coverage, the policy is not optimized for aggressive cash value accumulation compared to fully funding, max funded IULs or fully underwritten IULs. That combination of higher costs, caps, participation limits, and sometimes delayed cash buildup is why these structures carry more risks of underperformance versus designed for cash accumulation, which is the sole purpose of an IUL. So why is this not ideal? The waiting period and graded payout reflect higher mortality risks, which show up as higher cost of insurance. In IUL, caps, floors, and participation rates already limit growth. If you add extra drag from graded structures, it increases the chances you won't hit the projected values. Now, we discuss the other option, which is the optimal switch, which is my favorite. Often, carriers usually let you request a change between level and increasing after the first policy years, and this is subject to their rules and tax limits. So for younger clients between the ages of 15 to 45 years, so you allow for heavy funding during the first 15 to 20 years of the policy. So you can start with the increasing during the funding phase and then switch to level when the regular premiums stop. This is often around retirement. For older clients, say between the ages of 55 to 75 years, can do the short-term heavy funding. Sometimes you start with the level right away or switch to level within 5 to 10 years to keep the cost of insurance manageable as they age or as the age-based charges rise. For the graded and the optimal switch, most agents don't even know this exists. So for these two products, one is a product design structure, and it's mostly tied to simplified issue and higher risks cases. The other is a design strategy inside a flexible IUL chassis. So graded can be useful when insurability is a challenge and you are compromising a pure cash value performance. So by contrast, an IUL built for cash accumulation generally uses full underwriting, careful premium design, and the increasing then level switch to minimize cost of insurance and also minimize the insurance drag and to maximize on long-term cash value growth potential. The other component of an index universal life insurance is the cash value. Cash value is the money inside your policy that grows tax deferred. It can be accessed tax-free. It is protected from market losses, can be used for retirement, emergencies, or opportunities while you're alive. Then the other term is indexing. Your cash value is linked to an index like the S&P 500, the global indexes, Nikkei 500. So S&P 500 typically means the top 500 companies in the United States. So in indexing, your cash value is linked to an index, but it's not invested in the market. This means when the market goes up, you earn an interest. When the market crashes, you earn 0% interest, not a negative. So this is why IULs shine during volatility. And then we now have the compound interest. And Albert Einstein said compound interest is the eighth wonder of the world. He who understands it earns it. He who doesn't pays it. And well, of course, if I say he, I also mean she. Both he and she. So, inside IULs, compounding works even better because you never lose the previous gains. You grow on top of a protected flow, and you avoid the sequence of return risks. The other component that is very important is what we call the options. Options are how the insurance companies protect you. Insurance companies use option strategy to give you an upside potential without exposing you to the downside losses. And this is why you get the 0% flow, a cap or a participation rate, the no direct market exposure. It's very good. And understanding this helps you see why an IUL is not only an investment, it's a risk-managed wealth vehicle that can build you a legacy, an everlasting legacy. Please listen carefully. Not all IULs are treated equally. Not all agents are trained equally. And not all structures will protect your money. You must work with someone who understands and designs your policy for your goals, not their commissions. You also need to work with someone who understands what MAC limits are. Make sure your agent knows how to optimize death benefit options. Make sure they can also explain caps, spreads, participation rates. Ensure your agent can show you realistic, not inflated illustrations. This is your money. This is your future. Your legacy. So, what are the red flags that you need to watch out for before you take up an index universal life insurance policy? Make sure you watch out for guaranteed retirement income. IULs do not guarantee income. Also, watch out for agents who can't explain how indexing works. Make sure you're watching out for policies that are designed with very high death benefit options and a very low funding. Please also watch out for, when your agent is not discussing what your MAC limits are. Also, when your agent cannot explain to you the optimal switch, that's a red flag. Ensure the illustration, is not showing a double-digit return every year. There could be an issue there. Then, the other thing that you need to watch out for is the pressure to sign quickly. If your agent is pressuring you to sign quickly, you better run. If you see all this, you better run. And so here are the questions that you need to ask your agent. Number one is, how are you structuring my death benefit and why? You can even ask them, what is my MEC limit? The other question you need to be asking them is, what is the cap? What is the flow? And what is the participation rate on my policy? Also, you need to be asking them, when should we switch from an increasing to level or vice versa? Also, make sure you're asking them, like how much of my premium goes towards cash value versus, cost of insurance. The other thing you need to be asking is, why is the long-term strategy? Like, what is the long-term strategy of my policy? IUL is not perfect, but when it is structured correctly, it's one of the best and the most powerful wealth tools available in the market today. If you want an IUL that is structured correctly, I help families, immigrants, and professionals build wealth the right way, with clarity, transparency, and strategy. Please subscribe and share this video, and let's build generational wealth together. Thank you, and see you in our next episode. Stay tuned.